What's up, everybody? Welcome back to Beer and Money. My name is Ryan Burklo. Mr. Collins will not be joining us today as he had to take care of a sick kiddo, but I wanted to bring an episode around tax loss harvesting. We get asked this question often. So today's episode, we're going to be talking about what is tax loss harvesting. You probably heard about it through the news or different outlets. So we're going to talk about what it is. And we're going to talk about 3 reasons why you might want to actually use tax loss harvesting. So without further ado, let's jump right in. So tax loss harvesting, what is it, right? It's essentially a strategy to lower your taxes by selling investments that have lost value. Now, I want to be clear about something like lowering your taxes. Make sure you're working with a CPA. I am not a CPA. I understand the taxation of investments, which is why I'm speaking into this, but make sure you are working with a professional when it comes to this, okay? So let's give an example. Let's just pretend that you have $10,000 in a stock. The stock goes down, and now the stock is worth $7,000. So you have a $3,000 loss. So what you can do is you can actually sell that stock at a loss, and it could reduce your taxes. That $3,000 can lower your taxable income. Or it can cancel out profits from other investments. So simplistic example for that, let's just say you've got that same $10,000 investment that's worth 7, right? So that went down. And let's just say you've got another investment that is worth 20. You bought it for 10, so there's this $10,000 profit that you have. If you sell both because you needed to or whatever, plan that you've got going on, the $10,000 gain in investment B will actually be lowered to $7,000 gain because of the $3,000 loss that you had in investment A. That's called tax loss harvesting. Okay, so that's what that is. We work with a lot of employees that work at Amazon or Facebook, right, or Microsoft. They have stock options, RSUs, all that kind of fun stuff. So there are several reasons why you might want to utilize this. So let's jump into those 3 reasons here. So reason number 1, as I just kind of explained, is it's offsetting taxes on maybe a stock-based compensation. If you work at Amazon, you're getting compensation via your RSUs. And so those RSUs are often generating taxable income. So whatever they're paying you in the RSUs, whatever that stock is worth at that moment, you're getting taxed on at the time that it vests. So if you're in a higher tax bracket, high earners, higher tax bracket, selling other investments at a loss, especially if maybe this year you're getting a huge RSU bonus type of structure. So maybe selling some other investments at a loss can reduce the capital gains or reduce the tax bill. Okay, so that's reason number 1 to do so. Reason number 2, diversifying concentrated stock holdings, and specifically diversifying it in a tax efficient way. We work with people all the time where they're reaching out to us and they've got 50% of their assets stuck at their company stock, right? Microsoft, Amazon, whatever that is. And so they've got this oversized portion, right? It's over concentrated. So it's so over concentrated that maybe their cost basis. So maybe, again, going back to simplistic examples, if they vested at $10 a share and now they're worth $50 a share, that's a $40 difference, right? So it's hard to then sell and diversify yourself because you're going to take a big tax hit in that concentration. So what you can do is with your other assets that you have, if you've got some losses there, you can sell those losses to offset the tax hit on your over concentrated stock, and maybe it won't be as high of a tax hit for you. And you're also diversifying yourself. So that's number 2. And number 3 is, maximizing your savings for family goals, right? Those losses that you're selling can provide essentially a hedge against future taxes, right? So you get to $3,000 is the max that you can offset or lower your taxes unless you're offsetting other investment capital gains. So you can kind of kick this can forward, and maybe it's vital for funding college saving or estate planning purposes. Right. So maximizing the tax savings for your future family goals is a 3rd reason to consider tax loss harvesting. Now, let me be clear about this. It may not be worth it to do it. This is why you want to work with the CPA and your financial advisor that you're working with. They should be coordinated with one another. They should be talking to one another to make sure that your goal and your plan is aligned with the taxes that you're about to pay. And maybe you want to pay the taxes this year because maybe the taxes will be lower in the future. At least that's maybe your plan of what you're doing. So make sure you're talking to both professionals and aligning that piece. That's what I've got for today. I hope this episode is valuable. Again, we work with people that have equity compensation. And the reason we started this podcast is to help you with your financial decisions and your financial goals to take actionable steps so that you can build a plan for your life and what you want to live. So we hope this episode was valuable for you. Make sure you check out the YouTube link in the show notes. Make sure you're hitting that like button to if you got any value out of this, right? This is how you get the information out there and share with your friends and your coworkers specifically, because maybe they don't know what these options are. That's it for now. Hope you have a great day. Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8396952.1. Expiration date September 2027.